Hello, everybody. My name is Nicole Elliott, and I'm a technical analyst and private investor. And today I brought you three slightly tricky charts. They're not obvious and in your face ones, but it's just something I'm thinking about tentatively. And they're all Eurozone related, EU Eurozone related. So my first chart is the weekly one of the Stoxx 600 Europe index. So these are the top 600 shares traded in Europe, and they do include little things like Switzerland and other bits and bobs as well. So it's not totally the Eurozone. And what you can see, it's a weekly chart. You can see the catastrophic collapse we've had since March. We didn't start at a record high, by the way. The record high was set quite some time before that. But there's major long-term resistance, which eventually did cap, and you can see we plunged through it. 50 and 200-day moving averages have crossed to bearish. This is a long-term fund manager style signal. They are very bearish. And at one point, the index had given up nearly 61% of the gains since 2009's low. So in other words, quite a bit more than what some other indices had given up, which was sort of, 38%, 50%, whatever, Fibonacci type numbers. And this is the worry that for so long, Eurozone shares and European Union shares have been, shall we say, depressed and towards the bottom of their secular range. And I just see absolutely no turn in sight, nothing at all. We have bounced like other ones, but we've been capped at the 38% Fibonacci resistance level. So I think they're going to give up the ghost yet again in either later in April or in May and just revert to trundling along the bottom. So I'm afraid that's not really very good news for anybody, is it? Now, moving on to my second chart, again, it's a weekly one, and it's the yield on an Italian 10-year government bond. And we had an absolute massive backup in the yield from about 1% yield to 3% yield, i.e. a tripling of all of this, as the head of the ECB, Madame Lagarde, suggested that it wasn't her job or her organization's job to monitor lot spread, as they call it in Italy, lot spread. Now, Italian bonds, 10-year this is, yield awful lot more than German ones. But what's troubling me here is that while we've sort of settled down to a slightly more normal level, more normal in the sphere of mad world that we live in, I've got a feeling that we might start trending up again on the yield for Italian bonds. And this is partly because the latest estimates are that Eurozone debt to GDP is nearly 100% already. So, then we're fighting the virus, aren't we? And it's not Italy. I'm not picking on Italy. The chart for the yield of Spanish bonos, the chart for French OATs, and even to a certain extent, the chart on bond yields are suggesting that unlike some other countries like Britain, like Norway, like Sweden, we're not bombing on down lower in terms of the yield. My third and final chart is one that you'll probably be familiar with. It's how many dollars do you need to buy yourself €1? I've added onto it the Ichimoku clouds, and you can see the relentless move lower, absolutely relentless. Volatility did increase significantly in March from very, very low, sort of 3% level up to 18%. It seems to have settled down a bit now. But again, this is another one. It's very low compared to its peak. It peaked in 2008 at $1.6. I mean, now we're nearly at $1. I mean, that's a massive slash in the value of the euro. And as you can see on this chart, there is absolutely no glimmer of a base building exercise whatsoever. So 3 different charts, very worrying but subtle picture. We'll ponder on it and watch them closely. See you soon.